Welcome back. You're watching Money, 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 and we are discussing ETFs this week with the Bharat-22 making headlines, of course, just last week. So we've got some questions from social media as well. Let me address them. We have a query in which one of the, respondents is saying, I would like to know about the basis of allotment in these ETFs. Is it on a first-come, first basis phenomena? Mr. Usagi?
So basically what typically happens in any ETF or anywhere where you have basis of allotment, if the issue gets undersubscribed, obviously everyone gets it. And if it gets oversubscribed, then it is basically proportionately it's allotted to every investor.
Okay. The other question is, what is the difference between CPSE ETF and Bharat-22 ETF? Which one would be better? Are there any tax benefits? Well, we've discussed some of the differences already. I mean, here we are talking about 22 stocks in the CPSE ETF. It's 10 stocks. In fact, I'll quickly point out the common stocks. So, the CPSE ETF is a bit of a subset of the Bharat-22. So, Bharat Electronics, Coal India, Engineers India, GAIL, IOC, ONGC, Power Finance, Rural Electrification. These are the stocks that are also in the CPSE ETF. In addition, you have Container Corp and Oil India. But the larger point, I mean, if you do want to have an exposure to either of these, then do you have a favorite?
Well, if I had to make a choice out of these two, I would certainly go for Bharat-22.
Okay.
Because it's more broad-based there. Like I said, there are some companies from the private sector which are already there. Some public sector banks are there. So even if I'm a new investor who's trying to build my portfolio, for a longer term, my portfolio is more diversified than what it was in CPSE, clearly. Because, most of the stocks are already there here.
And tax implications, ETFs, these are equity ETFs, so they're treated like any other equity fund, right?
Oh, exactly. I mean, you have the same tax benefits, which means that if you hold your investment for a period of 12 months or more, then all your capital gains are tax-free. But if you were to sell it within 12 months, then you end up paying short-term capital gain of 15%.
Okay, fair enough. Now let's, expand this conversation to the point we were just raising earlier, which is whether as an investor, I mean, you're in the market to make money and to sort of create wealth, right, through mutual funds or through direct equity, whatever's the route you choose. Whether passive investing makes sense at all compared to active investing. How do you sort of stack it up?
See, if you really have to compare passive investment with active investment, the problem with the passive investment is, let me just talk about what are the things which are in favor of passive investment. If you're talking about an ETF, okay, your investment universe is defined. You know exactly where your money is going to be there, how much money is going to go in which stocks. Before you enter, And most of these, ETFs are very well diversified. I mean, whether you look at Nifty 50 or BSE 30, there may be 30 stocks, but the fact is they're spread across different sectors. So you have a well diversified portfolio. But the thing is, there is no role for the fund manager there.
Absolutely.
Ideally speaking, when you go to a mutual fund, you go to a fund manager thinking that he'll manage my money. He will make sure that I get benefit of what is happening in domestic economy, domestic market, internationally. So I think when you come into an ETF, you kind of decide that I'll be very happy with the market return. I don't want to get better returns than market. So clearly, I think that's one problem with the passive. Of course, in terms of cost, if you see ETFs are cheaper than active funds.
Yeah, because there is no active management of money.
Exactly, so, but the thing is that there are certain costs. Sometimes we don't talk about it. I mean, if you say...
like what?
Like the fund may be charging you, much lesser than what they're charging in actively management. But the thing is, it again depends on if you have opened a demat account only for an ETF. So you're paying brokerages for that, and you're also paying for maintenance of your demat account, the transaction charges. So clearly there are costs. Sometimes we don't really focus on that. So it's not that it's much cheaper. But at the end of the day, if your actively managed fund is going to give you much better return. We just touch upon that issue of, like I said, CPSE has given a return of 16.61. Other ETFs...
The last 1 year, the CPSE...
Just to give an example. Other ETFs in the large cap category has given 22. Actively managed fund, if I were to look at... Again, I'm looking at large cap funds. I'm not looking at multi-cap funds or mid-cap funds. Have given, many of them are given in the range of 24% to 30%. Now,
so that's a straight beat over the index. The index itself has done about 24-25% in the last 1 year.
Exactly. Okay. So my point is, even if I have paid higher charges for actively managed fund, look at the benefit I'm getting. At the end of the day, there is a difference of 6 to 7%. In the last 6 months, or even if you look at 2 years, I think the returns are much, much better. 3 years is even better. So clearly what we need to see is over a longer period, if actively managed funds, if chosen well, of course, that is very, very important. they give you better returns. So I don't think I need to really focus too much on how much is the cost, and it doesn't make a difference to me. At the end of the day, I get benefit of expertise of the fund manager. Every fund has a philosophy. Investment universe is much larger compared to ETFs. So my bet is always on the actively managed fund.
Okay, fair enough. On that note, we're going to take a quick break, but we also have some regular mutual fund queries. As always, our viewers know Mr. Rustagi is here, so they do want some advice on their existing funds as well, the actively managed funds. We will address the queries after the break.